Oh, welcome into a daily editorial here on the KE Report. In this daily editorial, I am chatting with Jordan Roy-Byrne, founder and editor of the Daily Gold. Jordan, I first want to address this comment that I've heard from a number of commentators and even some of those people that comment on our blog talking about how the precious metal stocks are performing compared to the precious metals. I did some research on this, and there is a case for, in a bull market, precious metal stocks truly outperforming the metal, especially in terms of percentage moves. But when it comes to predicting a bottom and predicting a turn, I really did not see too much data that was conclusive there. Some years, yes, it absolutely did, where we saw metals start to rebound, but a lot of the time, too, they seem to rebound at around the same time or even a month later, but then again, it was all about their outperformance as both were moving higher. What do you consider to be some of the key aspects or key ratios, relationships that you look at in terms of, is it stocks compared to the metals or is it other things?
Well, Corey, that's a great question, and I don't want to wax too much philosophically on this because that's what we're doing here. But I think breadth indicators tend to have a better, I mean, if you're looking at the miners versus the metals versus breadth indicators, I would prefer breadth indicators. However, I mean, there are some instances where the miners versus the metals, that ratio has been right quicker or sooner than the breadth indicators. So that's why you really have to look at a host of things. At present, we are seeing the miners lead the metals. That ratio, GDX to gold, did make a higher high. I mean, the Huey versus gold, that has also made a higher high. GDXJ is lagging a little bit. But quite simply, I want to go back to the beginning of what you said, because you said they lead when they're in a bull market. The problem is metals are not in a bull market. Now, miners are getting very close. It looks like they're, if this move continues, miners are probably going to confirm a bull market before the metals. Mm-hmm. So it's a good thing that the miners are leading. Don't get me wrong, but the metals are not in a bull market yet. Now, obviously, with the miners leading, if they continue to move and go to new 52-week highs, eventually that's good for the metals. But that's the only thing that concerns me right now, is that the metals are pretty weak. Their charts look pretty weak. Part of the reason why the miners are doing so well is because the metals are so weak here. And, is that because the stock market is, we had this great rebound and it sold off a little bit and maybe it'll correct more. But, the relative strength in the stock market, does that explain why miners are performing better than the metals? If it does, that's not the best thing for the sector as a whole. But nevertheless, I think the real key here to watch for is to see if miners, GDX specifically, and then also GDXJ, is to see if they can make new 52-week highs and break their recent highs. Now, if that happens, and we see new 52-week highs there, and that happens ahead of the metals, then that's a very good sign. But here and now, yes, the miners are outperforming. That's a good sign. But the miners nor the metals, they've not made 52-week highs yet. So there's not, yes, the miners are outperforming. There's a clear divergence, or not a clear divergence, I should say. There's clear outperformance going on. The ratios look strong in favor of the miners, obviously, but there's no strong positive divergence. And so that's what I would urge people to watch for in the days and weeks to come, is to see if miners can make new 52-week highs, make a higher high before gold and silver make a higher high. Now, if that happens, then I think, we really have something going here as far as the outperformance. So overall, yes, it's a good sign, but it's a little early to say, this is a sign that we're going to blast off. The thing to watch for, again, is to see if the miners can make a higher high and hit new 52-week highs as the metals are lagging. If we get that divergence, that would be an even stronger sign.
Okay, so it's all about divergence and breakout, something that I know metals, bugs, metals, precious metals investors, and even the generalists have been waiting for some sort of a breakout to the upside. Regarding GDX, though, if we close, let's say, right around this 23 level, you can make an argument that that is, from a weekly perspective, a more positive close, actually a new high close, I think, for the year. Actually, it needs to be just above 23 because 23.06 was a close at the tail end of February. But if we get a weekly close above there, you can make the argument that that is a 52-week high in terms of closing prices. But then you have all these other resistance levels. You can make the argument 24.73 and more likely just 25. There's still some near-term resistance. So is that enough of a breakout for you to make you even more bullish in GDX?
That's a very good question. Yeah, I'm focused on the same thing you are on the weekly chart. A clear close above 23 on a Friday. That's going to be a breakout on the weekly chart. There is resistance at 25. So what I would like to see would be obviously a breakout on the daily and the weekly charts, and a rally up to 25. That resistance at 25, and GDXJ also has resistance at 37.50, though it's lagging. It's lagging right now. But the key thing, Corey, in the GDX advanced decline line, we're seeing a positive divergence there. So that's very encouraging. But really what I'd like to see is the percentage of stocks in the Huey and GDX, which are trading above the 200-day. Those are both around 80% right now. We've talked about it before. I want to see those reach 90%. So GDX, I mean, if it makes a higher high, then I think it's likely probably going to reach 25. And look, if it by the time it gets to 25, if we see 90% or more than 90% of the seniors trading, or the large caps trading above the 200-day, I mean, that's really, really encouraging. That's bull market action there. So to me, that's what would be more significant than GDX just breaking a certain resistance level or reaching a certain target.
Okay, so again, we still just don't have that confirmation, but things are looking positive. Can you also talk about that GDX advanced decline line, please?
Yeah, and so looking at just a daily chart here, that advanced decline line in the last couple of days has gone well above its February high. So there's a positive divergence there, where the advanced decline line has made a clear higher high. It's moved in a short-term sense. It's moved well above the peak from February. GDX right now is trading a little bit below its February peak. So its GDX has not made a higher high yet. So the advanced decline line there is very encouraging. And like we said before, I mean, one of the other indicators I look at is GDX against gold. We were talking about that. So that's also made a higher high. So, looking at both of those together, that's very encouraging. And really, one of the last things would be to see the percentage of stocks in the Huey. And I use the Huey and not, I mean, the Huey is basically GDX minus the royalty plays. But if we do see that percentage of the Huey trading above the 200-day get up to 85, 90%, that would be another another very positive development. So yeah, things are looking good here, Corey. We just need to see a little bit more to happen, and then we can really say, there's a lot more confirmation here.
So driving down into another stock that is actually showing some serious strength is also Barrick. This is important because this is still, at least right now, the largest miner in the world. Can you take a look at that Barrick chart and tell us what it means to you?
Yeah, Barrick, it's made a clear breakout. It's a very good-looking chart. It had this strong move up from September into November, from about 9.5 up to 14. And since actually, it looks like the peak was in December, but it's basically, it also, the closing peak was in December, I should say, but it did at one point in October trade up pretty close to 14. So you can say it's been a correction since December or a consolidation since October. But the thing about this, Corey, is Barrick, it had a very sharp rise and it was able to digest that. I don't have the Fibonacci I'm just eyeballing it, but it looks like it retraced only 50% or less than 50% of the move. It also formed kind of an inverse head and shoulders continuation pattern. Usually that pattern is a top or a bottom, but sometimes it shows up as a continuation pattern, as it did here. And so this has a projected upside based on this breakout up to 1650, or there's also potential if it duplicates the original move for it to go to maybe 1750 or even 18. So this is a very good looking chart. And in the last couple of days, Corey, it broke to a new 52-week high. So the term breakout gets tossed around way too often. But the thing to look for is new 52-week highs. And so that's exactly what Barrick did. It's in a clear breakout mode. And, there's even more upside here in the near term for that stock. And again, Corey, it's hard to be like negative on the sector or bearish when you have the biggest gold producer breaking out to a new 52-week high.
Yeah, very true. And that is, I think, what we have been waiting for, too. A little bit more money coming into some of the majors. But one thing to consider, too, is that 52-week high is also met by some more resistance pretty short term because of the fact that Barrick, for example, has trended down ever since 2016, that bounce that it had. Can we also address, stepping a little bit away from the actual precious metals sector, is the 2-year yield? You recently put out a flash update to your subscribers outlining why you watch the 2-year yield so quickly, being a barometer for Fed policy. Please share some of your insights.
Yes, Corey. And I also wrote a public article about this in the last couple of days, so you can look at that on my website if you're not a subscriber. Basically, the Fed tends to follow the 2-year yield. So if you're looking for a proxy or a leading indicator of Fed policy as far as rate hikes and cuts, that can be the 2-year yield. And I looked at the 2-year yield versus the yield curve and the cuts in precious metals against the stock market. And now, there's been many different rate cycles, but just looking at the last two, what's really interesting is the 2-year yield from the time that the Fed basically stopped hiking and then they paused and went to a cut. During that period, the 2-year yield basically had a really sharp decline. It declined, if you're looking from 2000 to 2001, it declined by well over 1% from its peak to the point where the Fed actually cut. Same thing happened from 06 to 07. And by the way, the cuts were basically the very beginning of January 2001 and then September 2007. So those were the start of the last two cut cycles. But basically, by the time the Fed did those cuts, the 2-year yield had already fallen dramatically and started to price in a cut. Well, what's happened now in recent months is the 2-year yield peaked close to 3% in November. And that's come all the way down to 2.24%. So that's basically, we can round up and say 75 basis points it's declined by. And, the Fed right now, they're supposed to be at 225 to 250. The 2-year is at 224. Now, what happens if the 2-year comes down to 2.00%? By the time that happens, that means the Fed is going to be behind the curve by basically a full 25-point cut. Now, obviously, it hasn't happened yet, but given the decline that we've seen, Corey, by the time it gets to 2%, you would think, the cut is probably going to be, 90% priced in by that point. Well, interestingly, right now, or I should say as far as a couple days ago, the Fed funds futures showed that there was like a 73% chance of a cut by the end of January 2020. So, Corey, we've been talking about this for basically a year, the importance of the Fed stopping their hikes and then going to a cut. The history on this is bulletproof, as I like to say. And what's been happening? So the 2-year yield has gone from 3 down to 2.24. The Fed basically, they stopped. They're in pause mode because December was their last hike. And, now the Fed is not the Fed, but the market is leading the Fed. The market is already starting to discount a rate cut. And that's why we see precious metals, well, the stocks especially, performing so well. And the stocks are on the cusp of new 52-week highs. Barrick is breaking out. The stocks are outperforming the metals. breadth is picking up. We see a positive divergence in the advanced decline line. So we're seeing all these good things one by one start to happen. and it goes along with the market starting to price in that first rate cut. And the other thing I'll mention, Corey, I mean, the yield curve, when people are talking about the yield curve, it's not the inversion which matters. It's the steepening. The steepening is what's bullish for precious metals and bearish for the stock market. So the steepening is really what you need to watch. And looking at the yield curve with the 10s and 2s, 2-year and 10-year yield, that is not inverted yet. But, what happens leading up to the rate cut as far as the last 2 cycles is the 10s and 2s curve started to steepen at least a couple months before we got that first cut. So that's something to watch for. I mean, bonds are really overbought here. So there is potential for us to see, a rebound in yields and the market starts to go the other way and we see higher rates again. But if that happens, the thing to watch for is to see how does the 2-year yield move in comparison to the 5, 7, 10, 30-year yields. If those yields are bouncing and having a decent rally, but the 2-year yield is kind of going sideways and not really rallying, that would be bullish for precious metals because that would show a steepening curve. And that would also signal that the market is, even if yields are rising, if the 2-year doesn't move that much, that would still signal that the market really thinks a rate cut is coming sooner rather than later. So I know that's a lot to take in with the 2-year yield, but just quite simply watch the 2-year yield and watch for the steepening of the yield curves.
Okay, we're going to leave it at that. Jordan, I do always appreciate your insights and taking a look at some of the technicals that I think are very important and also outlining what actually is important for investors to look at. We can get just bombarded with, I think, way too much information, and sometimes it's always good to take a step back and understand really what does matter rather than getting distracted by all of the noise. Jordan, good chatting with you. Thanks again for taking some time, and have a great rest of your week.